So today's video is going to be on the subject of inflation and what kind of issues it represents. I know a lot of my videos recently have been sort of focused on negative things about housing market crashes, debt crises, and things like that. And the unfortunate reality is there's a lot of uncertainty what's going on in the financial world, and there's a lot of negativity right now with that, unfortunately. Hopefully I can get some more optimistic videos moving forward, and inflation is another one of those issues. Now, the thing about inflation, though, it's not necessarily a looming issue. The debt crisis and the mortgage crisis is something that's looming. It's really right there. It's an issue right now. Inflation is something that comes into play once those issues get resolved, either through a crash or if the market just fixes itself with the help of government regulations. So, what is inflation? Well, let's start off with why this is an issue and where it started. As most of the issues presented by the economy right now, it started in 2008 with the mortgage crisis. As I've mentioned in previous videos, one of the things, or the main thing that countries did in order to get out of the 2008 recession and cut it short is they introduced money into the economy. They threw money at the economy. It was sort of like an Oprah show, like you get a stimulus package, you get a bailout, you get this. Just throwing money everywhere. And so they introduced an insane amount of money into the system, and so what happened was that money then led to economic growth, and it restarted the economy. It kick-started it, effectively. But that created a significant problem. Now, inflation, when it comes to monetary issues, is effectively when there is new money introduced into an economy, into a country, it reduces the value of the money that was pre-existing there. So what that effectively means is as the total amount of money increases, as a country throws new money into a system, everything that you already had or that was already in the system, its value goes down just because there's more money overall total in the system. Now, because of 2008 and what countries did, they threw money at the problem, the 2008 mortgage crisis. Well, because there was so much more money introduced into the system, theoretically inflation rates should have increased. Now, typically, countries will aim for a 1 to 3% for inflation, and inflation in a small amount is actually a good thing, because what it does, it promotes economic growth. It promotes investing, which increases the value of an economy, and it does positive things. But it has significantly diminishing returns after that sort of 3%, that 1 to 3% sweet spot. Once you get into 4, 5, 6, it starts being a huge issue. Now, as I was mentioning, because 2008 they threw money into the economy, you'd expect to see significant increases in the inflation rate. But you didn't. It's still around that 1 to 3 sweet spot, which is very strange because countries threw billions at the 2008 mortgage crisis. They really pumped the market full of money. So what's going on? What happened? Why did inflation not increase? Well, because there's so much uncertainty in the market right now, a lot of that money is being hoarded. So it was introduced into the system, but banks took a lot of that money, hundreds of millions of dollars worth of it, and they're sitting it in cash reserves. They're sitting it there. They don't know where things are going to go necessarily, and they just want sort of a slush fund to help out with any issues that might arise. You see this in a lot of major corporations as well. Companies sitting on hundreds of millions of dollars, unsure of what's going to happen with the market, so they don't want to invest in new projects if there's about to be a crash. They don't want to sort of explore into new areas if there's sort of any potential for issues that might arise in the near future. So there's a lot of companies, banks, and corporations that are sitting on these huge cash reserves. So what happened? The government introduced a ton of money into the market, and then a lot of that money was taken by companies, corporations, banks, and they just hoard it. They're keeping it right now. So the money was created, but it hasn't been introduced in the market. It hasn't been pushed in. It hasn't been used. So it hasn't actually realistically taken effect yet. It hasn't increased inflation because it's not actively being spent. It is just being kept and hoarded by these companies. So why is this an issue? Well, hypothetically, what happens? Let's say we have a mortgage crisis. It breaks, the economy crashes. Then, after whatever period of time it takes for the economy to recover, it comes back. Well, these banks, corporations, and companies that are sitting on these huge cash reserves suddenly say, oh, well, the economy's finally coming back. Things are looking better. There's less uncertainty. They start using that money. They start investing that money. All of a sudden, these multi-billion dollars of extra money that was created and introduced into the economy is suddenly being used. And that's when inflation starts to take effect. It hasn't yet because the money is not actually being introduced into the economy. It's being held. And so all of a sudden you're going to go from that 1 to 3% sweet spot and it's going to spike. And it's going to spike real fast because it was a ton of money introduced. And what is inflation? Some of the issues, interest rates will spike as well. You'll see interest rates go from where they are right now at historical lows, 1 to 3%, 10, 15, 20%. You'll see investment opportunities dry up because it's so expensive to do that. Inflation, when it gets above that 1 to 3%, causes a huge amount of issues. So inflation is a significant problem, and it's something that not necessarily right on the horizon, but it's something that's going to take effect once we get through the issues that we have right now. So how do you protect yourself against inflation? Well, that's kind of an issue. It's difficult to do. One of the bigger issues with inflation, if you're looking at investing in things like bonds right now, which has a fixed return, let's say it offers you a 2% interest rate for 30 years. You're going for a really long-term bond. An issue with that is if inflation spikes to 30%, or not 30%, that's pretty high. It's unlikely to ever get that high. Let's say it spikes to 15%. That's still high, but reasonable with the amount of money that was introduced. At a 15%, you're going to be looking at an interest rate in that realm. Your bond that's producing 3% is very significantly lower than what actually is the market interest rate. So it distorts things like bonds in the debt market. People that have mortgages who are paying 5% upon renewal, who have to spike up to 15%, that often will break them. They can no longer sustain that amount of debt. So it presents a lot of issues. Again, it's not something that's going to hit right away, but once the current issues get resolved, once the market uncertainty is overcome right now, you're going to see huge inflationary effects taking place. And sort of, what are some of the issues? Again, bonds. Avoiding very long-term bonds, probably a good idea. Currencies might lose value, so avoiding investing heavily in those is probably a good idea. Obviously, though, prioritizing protecting yourself against potential market crashes first, and inflation is something you'll need to worry about after that comes. Hopefully that's sort of broken down a little bit about what inflation is, what kind of risks it presents. It's sort of the issue before in the sort of the distance. You know, you want to focus on the one that's presented right now, and then you'll get to that later. So something to think about, not necessarily to worry too much about right now, but it has the potential to become a significant issue in the near future. Again, if you like the content, please feel free to share, like, and subscribe. It helps me out. Thanks.